This is Real Money. You're the most important part of the show, so join our live conversation for the next half hour on Twitter at Ali Velshi or on Facebook.com/Ali Velshi. Another down day in the U.S. stock market. It's got many people nervous about their investments and wondering what to do next. I wanted to bring you some informed advice yesterday, but we ran out of time because of breaking news. Kathleen Sebelius resigning as the Secretary of Health and Human Services. So I'm going to keep my promise to you. In a moment, we're going to get some expert advice on what, if anything, you should do now with your portfolio. But first, let's look at what happened today. The tech-heavy NASDAQ followed its 3% drubbing on Thursday with a 1.3% decline today. Now, this is the third straight weekly decline for the NASDAQ. The Dow lost 143 points. That's 0.9%. And the more diversified S&P 500 also fell nearly 1%. Now, here's where we stand for 2014, because we don't want to look at one day in isolation. The Dow is down 3.3%. It's only been a few months. The S&P is 1.8% lower. The NASDAQ is down the most, as you can see there, at 4.2%. The roots of this sell-off are fears that companies, some tech companies like Facebook, Twitter, Netflix, Tesla, you name them, other momentum stocks aren't worth the lofty prices to which they have climbed. And yes, that's making this feel a little bit like 1999. Back then, there was an even bigger tech sell-off coming off a long bull market run, sort of like we have now. So you can understand why some investors wonder if history is about to repeat itself. The question then is whether this downturn represents a buying opportunity for you. So let's ask someone who is paid to answer those kind of questions what he's telling his clients and why he's telling them to wait for a bigger pullback or correction. Money manager Doug Flynn joins me now. He's the co-founder of Flynn Zito Capital Management, and he joins us from his offices in Long Island, New York. Doug, are you getting panic from your clients over this?
Actually, no, we haven't gotten much panic at all. The only real selling that we're seeing is people who have gotten a little bit of a higher tax bill than they anticipated because of capital gains rates and the new Medicare higher tax, and they need money. And so when you're going to sell to free up some money, you're looking at what has made me the most money over the last couple of years. That's probably the thing I want to sell. These
are some of these stocks that are up more than 100%. However, if you are not selling to pay a tax bill, your advice to people is take advantage of pockets of volatility. What do you mean by that?
Well, you know, you can look and see one of the key things that happens is, you know, what has gone up the most will certainly react most negatively when things turn around. And within this area, within the NASDAQ is up over 60% in the last 2 years. So it's more than the market. Biotech is up, as you said, more than double. So you're going to have the biotech index now more than 20% down, and the NASDAQ down more than the general market. But within there, if you look, large company value stocks, which last year in 2013 were kind of boring. They didn't do as well as the overall market.
Sure.
But what's interesting is in the last 4 weeks, it's the best performing sector.
Right.
And so what happens is you have an odd situation where the best performing asset class over the last month during a volatile period was your worst performer over the last year. And that's exactly what you want to look for. You want to look for an opportunity in there and say, if I want to be in the market, but I'm afraid of biotech and tech, and I missed the opportunity with Facebook and Tesla, you know, here's another space within stocks that I could consider. Or if I want to buy those other tech stocks, I got to wait for it to get a little bit cheaper before I get in.
And some of those large cap value stocks, if you buy it in an exchange traded fund or a mutual fund, you're looking at things like Exxon, GE, Johnson & Johnson, companies like that.
That's exactly right. And so it's, you know, in those types of stocks are slow and steady, wins the race. They're somewhat boring. They pay a little bit of a dividend. But if you look at the last 4 weeks, it's almost a non-event. So if you are properly diversified, that's why I don't think we're getting a lot of panic selling, because if you have those in your portfolio, they're still hanging in okay. It's these other high growth momentum stocks that are getting crushed. So perhaps, you know, there's three animals on Wall Street we know. Bulls make money, bears make money, but pigs get slaughtered. So there's nothing wrong with taking some profits, taking some money off the table on some of these things, and even being off a little bit from the all-time high is not a bad time to do that.
Doug, always good advice. Good to see you. As always, Doug Flynn is the co-founder of Flynn Zito Capital Management. You can follow them on Twitter at Flynn Zito. Good to see you, Doug. All right.